Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Stocks extended their New Year weakness with the risk on sentiment strongly fading. Dollar extended its gains, but all of this seems as if markets are simply tapering their extreme rate cut expectations. We have seen all of this before, markets being more hawkish than the Fed and markets being more dovish than the Fed. Good morning, JK. What did the Fed minutes yesterday indicate? How are you reading Fed sentiments?
Good morning, Swaraj. Frankly, Fed minutes was not any trigger for stocks to sell off. Stocks have been selling off in the last, or rather, the first few days of the new year, retracing some of the large gains that they made in the month of December. And this was also based on dovish expectations from the Fed. Market discounting as much as 1.5% rate cut, and then starting as early as March. But Fed minutes gave no indication of when they will start cutting rates. So that was the negative part for the market. On the other side, they also talked about when we can moderate the balance sheet reduction by the Fed. So there's nothing you can say that Fed minutes triggered the sell-off. The sell-off is mainly the profit taking that has been going on. We have heard about Apple shares being downgraded by another investment banker. This is the fourth time Apple shares are being downgraded by big names, and also reports indicating that the owner of Meta selling large chunk of Meta shares in the last few months, as much as 500,000,000. These are not good news for the market looking to build on its gains of last year. And of course, the most crucial part is whether the expectation of soft landing by the US economy can be achieved or not. We are not seeing data recently which supports that the economy is doing extremely well or not slumping. It's on the middle level, but definitely we had evidence of the manufacturing contraction continuing, which was confirmed by ISM survey yesterday, and we will of course see the services side also. But manufacturing is definitely confirmed to be in contraction, both by the S&P survey as well as by the ISM survey, where the order book is seemed to be on the decline. Employment is also on the decline. So we will have to really see how Fed responds if the data continues to be on the lower side. Of course, we have the crucial employment numbers this week. Yesterday, we also had the Jones data, job openings and labor turnover, and that indicated that the job openings for the month of November fell further from the level in October, and the quit rate was lower. So we are seeing actually a moderation in the job sector. Also, we have the ADP private roles data today, along with the Challenger job cuts. Both of them were weak last month, and the final number will be the unemployment data, rather the non-farm payroll data on Friday, expected to be in the region of 1,50,000, and unemployment rate to edge up to 3.8% from 3.7%. Even the wage inflation is expected to be lower. So market is still assessing whether the economy will have a deeper slump or it's going to be on the balanced growth side, and a lower interest rate from Fed is what is also being discounted. So if there is going to be, if you are expecting a big rate cut, that means the economy is going to be in a big slump, and that's not good for the stock market. So the excessive rally that we saw in the stocks last year, that's getting corrected now. CAPE ratios show that US is one among the highly overvalued markets in the global scenario. So that's about the stocks. Even the yields yesterday had some kind of wild swings, initially rising with profit taking continuing by players, but then it fell back after the Fed minutes. 10-year, in fact, rose from 3.94 previous day to high of 4.01 before falling to 3.89 towards the close. Now, markets are now preparing themselves to face the numbers on employment, sector in the coming days. Then, the risk-off mood was also driven, partly by the escalating geopolitical tensions after one of Hamas leader was killed in a drone strike in the Lebanon's capital. And, there has been a buildup of tension already in the Red Sea region where ships are being, attacked, and US side is also, or rather the task force set by the US is also countering those attacks. So these are not giving good uh, positive vibe for the stock markets. Then we have the oil prices that climbed about 3% after a disruption in Libya's oil field also, which already added to the concerns in the oil sector. We will have the currency market, which is looking to correct itself, and more correction is what I am looking for. On the dollar index, it's already come above 102. Correction up to 103.50 will be par for the course. This is notwithstanding the underlying trend of dollar being weak. Now, just to give you a perspective, the US fiscal position is something that the market will not take off its focus from, because the US debt rose to 34 trillion end of December, and this is just after 3 months after it touched 33 trillion. So it just took only 3 months for its debt to rise by 1 trillion. So this is something that the market will keep an eye on, and how going forward, how this government can raise and fund itself, its increasing debt, whether dollar will be made weaker to attract foreign fund flows. These are the larger issues that the market will be dealing with, and that will be a negative for the dollar as well. So we did have euro falling to 1.0890 levels, and GBP to 1.26. Yen also went up to 143.60 levels from their best levels seen about a week back. But these can continue for some time. It's just I'm seeing it as a technical correction, but the underlying factors for the dollar are the rate cuts expected to be led by Fed, and then the core issue of fiscal deficit and also the dollar diversification that will rule the underlying sentiment for the dollar, of course. On the rupee, so good thing is that despite the dollar strength that we saw in the last 2 days, the rupee did not weaken beyond 83.35. In fact, there has been some consistent selling that has been seen from some of the foreign banks, possibly related to new allocations for the new year that has come through, and not so vigorous buying from the PSU banks as well. Also seeing some corrections into the INR crosses like Euro INR and GBP INR, which have moved up more than 6% in the last month, and making the INR a bit oversold. So these are leading to some correction in the USD INR as well. Yes, if we do see continuation of the flows, we should see USD INR touching 83 on a conservative estimate in the coming days. Yes, it's all down to the data that we will see today and tomorrow. Of course, let's not forget that we have the crucial inflation number from Germany today and from Eurozone tomorrow. These will be coming before the non-farm payroll data. So a lot to digest going forward. Thank you.
Thank you, JK. And as you mentioned, stocks have been selling off since the new year, retracing some of the moves in December. While Fed minutes gave no indication about the timing of the rate cut, it also discussed when the quantitative tightening can be moderated. US ISM survey showed manufacturing side being in contraction, order book and employment has been in decline. Job openings data yesterday also indicated further fall in the November numbers. The data to look forward to today, though, will be German inflation. And for tomorrow, we have the US non-payrolls unemployment rate, which will all be at focus. For rupee, we did not weaken beyond 83.35 despite the broad dollar strength. And we are witnessing some correction in INR crosses like Euro INR and GBP INR. That's it from us, Rick. Thanks for listening. Tune in tomorrow for the latest of the financial markets.